Welcome to the Deep Dive. We're the show that, cuts through the noise, digs into the sources, and pulls out those nuggets of knowledge that really get you properly informed. Today, we're plunging into an area of finance that's seen explosive growth, almost under the radar sometimes, Islamic finance. And specifically, we're going to unpack Sukuk. You often hear it called an Islamic bond. Why? Let's think about this for a second. By the end of 2012, Islamic financial assets were already estimated to be over $1.6 trillion. And the very first sovereign Sukuk bonds, they came out of Bahrain way back in 2001. So our mission today is to really explore what Sukuk finance is, how it actually works, what are the fundamental principles behind it, and maybe most importantly, what do some recent successes and challenges tell us about its role in the whole global financial picture. You're definitely going to walk away from this deep dive with a much clearer, more nuanced understanding of this pretty unique financial instrument. And maybe, just maybe, it'll make you question some assumptions about finance itself. Okay, so let's unpack this. At its heart, Islamic finance. It doesn't just operate differently, it really thinks differently. It's built on a very specific rationale, one that's deeply rooted in Sharia principles. These govern commercial and financial deals. It's not just rules, it's more like an ethical framework. So what exactly are these foundations? What makes it stand apart?
That's definitely the right place to start because understanding these core ideas is really key to grasping everything else. The whole framework of Islamic finance essentially rests on three fundamental pillars. First, you've got equity. This basically means every transaction has to be fair. It needs to be transparent. All parties involved must be able to make informed decisions without being misled or cheated. It's about partnership, really, and sharing risk. Second, there's a strict prohibition on forbidden transactions. Now, this covers the obvious things like no financing for alcohol, pork, weapons, gambling. But crucially, it also extends to pure monetary speculation. So things like options and futures, when they're used just for speculation, are generally out. And the third pillar, probably the most widely known, is the strict prohibition of interest, which is called riba.
Riba, meaning excess.
Exactly. It literally means excess, and it's just not allowed.
Wow. That's such a stark contrast to conventional banking, isn't it?
It really is.
I mean, in the traditional system, banks lend money and they earn interest on that loan. Simple. So how does this ban on riba completely change how an Islamic bank works? What does that look like day to day?
Well, it forces creativity, essentially. Instead of just taking deposits and lending that money out for interest, an Islamic bank channels those funds into actual underlying investment activities, real-world stuff. It's the profit generated from these tangible investments that gets shared back with the depositor, after a management fee.
Okay, so give me an example, like buying a house.
Perfect example. Instead of getting a traditional mortgage where a bank loans you money plus interest, an Islamic bank might actually buy the property itself from the seller. Then it resells that property to you, the buyer, but at a profit. You then pay the bank back in installments over time. So the bank earns its profit from the trade of a real asset, not just from lending money. It's asset-backed.
Got it. Tied to something real.
Precisely. And this whole approach leads to a range of different financing techniques. You can broadly think of them in two categories. There are the fixed income modes. These focus on asset-based deals with pre-agreed profit rates. Things like murabaha, ijara, and of course, sukuk fall here. Then you have the equity modes, which are more about shared risk and sharing profits or losses, like mudaraba and musharaka. It creates a really broad, adaptable system, all sticking to those core principles.
Okay, so if we look at those fixed income types, like murabaha, that sounds like a kind of trade credit.
That's a good way to put it.
The bank actually takes ownership of the asset first, maybe legally, maybe even physically.
It can be either, yes. Constructive or physical.
And then sells it to the buyer at a pre-agreed profit, paid in installments. And what's interesting, you mentioned no extra penalties if repayment takes longer.
Correct. No markups or penalties for extensions. That's a key difference from conventional late fees.
And then ijara, that's like lease finance.
Exactly. Lease finance is the closest equivalent.
So the bank makes an asset, say some equipment available for use for a fixed time and price, and the bank, the lessor, handles major maintenance, while the customer, the lessee, handles upkeep. It really sounds like the bank acts like a true owner, not just a lender.
That's the idea. They bear the risks and responsibilities of ownership. And it's within these frameworks, particularly the ones centered around assets, that Sukuk finds its place.
Right. Which brings us neatly to Sukuk itself, the Islamic alternative to conventional bonds. So how is it formally defined, and what's the absolute key difference we need to get?
Okay, the official definition, this comes from AAOIFI. That's the Accounting and Auditing Organization for Islamic Financial Institutions.
Catchy name.
Ah, yes. They define Sukuk as certificates of equal value representing undivided shares in the ownership of tangible assets, usufructs, and services, or in the ownership of the assets of particular projects or special investment activity.
Okay, usufructs. This sounds technical.
It does, but it basically just means the right to use something and enjoy its benefits, like the income from a rental property, without actually owning the property itself. It's a right to the benefit, the fruit of the asset. But the critical distinction here, the real takeaway is this. With Sukuk, the finance provider, the investor, actually holds ownership of real assets, or at least a beneficial right tied to them. And the return they get, it comes directly from the income generated by those specific assets.
Not just interest on a loan.
Exactly. It's fundamentally different from a conventional bond where you just hold a debt instrument earning interest. Here, your investment is tied to tangible economic activity, to an asset's actual performance.
Okay, this is where it gets really interesting, though, because I know there's been a lot of debate about whether Sukuk is really more like debt or more like equity finance. It's not straightforward, is it?
Not at all.
Yeah.
And understanding that difference is crucial to understanding the Sukuk market itself, because there are basically two main types, and how they're structured completely changes their risk profile. Let's break down the key differences between asset-based Sukuk and asset-backed Sukuk.
Okay, lay it on us.
Right. So with asset-based Sukuk, a common example is Sukuk al-Ijara, the lease-based one. Generally, here's the flow. Sukuk holders subscribe, they pay the issue price to something called a special purpose vehicle, or SPV.
Right, an SPV, just to be clear for everyone, that's basically like a separate legal entity set up just for this one deal, correct? Keeps things clean.
It's exactly right. Think of it as a dedicated little company created solely to hold the asset and manage this specific financing transaction. It isolates the deal. Now, this SPV uses the investor's money to buy an asset from the obligor, that's usually the company that needs the finance, the one selling the asset initially. Legal ownership of the asset passes to the SPV. The SPV, now the owner, then leases this asset back to the obligor under that Ijara agreement we talked about. The obligor pays rent to the SPV. The SPV then distributes periodic payments covering both rental income and some capital repayment back to the Sukuk holders.
Okay, makes sense so far.
Now here's the key for asset-based. Ownership lies with the Sukuk holders via the SPV. So technically they maintain and insure it. And crucially, if the obligor default stops paying rent, the Sukuk holders have recourse back to the obligor. They can go after the company itself.
Ah, okay, so that makes it feel much more like traditional debt, right? Because the original company is still ultimately responsible for paying up.
Precisely. The obligor remains on the hook. That recourse element makes it function very similarly to a conventional bond in terms of risk for the investor. Now, contrast that sharply with asset-backed Sukuk. Think of, say, securitizing a portfolio of existing leases. In this case, Sukuk holders subscribe to an SPV. But this SPV buys a whole portfolio of assets that are already generating income, maybe a pool of existing leases. The SPV gets the title deeds, owns the portfolio outright. The income stream from these leases flows directly to the SPV, which then makes distributions to the Sukuk holders.
Okay, so what's the crucial difference here?
The crucial difference is that all the risks and rewards of owning those assets pass entirely to the SPV, and therefore directly to the Sukuk holders. If the income from those assets dries up, well, the Sukuk holders bear the loss. There's no recourse back to the original seller of the portfolio. And when it comes time for redemption, the Sukuk holders get paid based on the open market value of those underlying assets, which, in a bad scenario, could be very little, potentially even zero.
Right.
So this type, asset-backed, definitely shares the characteristics of equity finance. You truly share the performance, good or bad, of the underlying assets.
So that difference, who bears the risk, who gets the reward, and crucially, who you can go after if things go wrong, that is a massive distinction for you listening. It's not just one thing called Sukuk. The structure really, really matters. Right. Let's shift gears a bit. Let's move from the theory to how this actually plays out in the real world. Time for some success stories. Where has Sukuk really worked well?
Well, Emirates Airline provides a really compelling case study, both of success and strategic adaptation using Sukuk. They issued their very first Sukuk. It was for $550 million, a 7-year deal back in 2005. And it was repaid completely, in full, right on schedule in June 2012. Their chairman, Sheikh Ahmed bin Zayed Al Maktoum, pointed out at the time this was always part of a very diverse financing strategy for them. Emirates has historically used a mix, conventional leasing, export credits, commercial debt, and various Islamic tools too.
So they weren't solely reliant on it, but it was a key part of the mix.
Exactly. But what's particularly interesting is why they started leaning more heavily into Sukuk, especially after the 2008 global financial crisis. You remember, traditional debt markets just seized up. They became incredibly risk-averse, even for companies like Emirates that were consistently profitable.
Right. Even solid companies struggle to borrow normally.
Precisely. Their president, Tim Clark, actually mentioned this. He said they'd traditionally relied a lot on European banks for aircraft financing, but the post-crisis climate forced them to look much more seriously at Sukuk. Now, financing brand new aircraft with Sukuk can be a bit complex. Remember the principles: no pure monetary speculation, need for tangible assets.
Yeah, the money flow needs to be tied to the asset itself.
Right. So the cash has to go from the investors through the SPV to the manufacturer before you can set up the leaseback. It adds steps. However, it's much simpler to use existing assets that the airline already owns for Sukuk financing. And Emirates did this very successfully. They executed 2 significant aircraft-backed Sukuk deals using existing planes. One for $500 million via GE Capital in 2009, and another $100 million deal through Nomura in 2010. So they found a clever, practical way to apply the structure.
And Emirates isn't the only one, right? I remember reading about others.
Absolutely.
Like Majid Al Futtaim, the big Dubai shopping mall developer. They actually chose a Sukuk program specifically because the pricing was better than a conventional bond option they had. And Turkish Airlines, too, using Islamic bonds to help finance their fleet expansion. So what makes the Sukuk market seem, well, relatively resilient, especially when things get shaky globally?
That's a really interesting point. The Sukuk market has shown surprising resilience during periods of global financial stress, even times when highly rated conventional companies found it tough to issue bonds. There seem to be a few key factors at play. First, the investor base, particularly Islamic investors in the Gulf region, tends to be pretty cash-rich. That provides a stable pool of capital. Second, compared to the demand, the actual supply of Sukuk instruments has often been relatively limited. Basic supply and demand that can help keep pricing favorable for issuers.
Less competition for funds.
Sort of, yes. And maybe most significantly, the behavior of Sukuk investors is often different. They generally tend to buy and hold these instruments until maturity. This buy and hold approach means less secondary market trading, fewer dramatic price swings based on market sentiment, or, say, credit rating agency downgrades, which can really rock conventional bond prices.
So more stability built in just from how people invest in them.
It seems so. It kind of bucks the conventional wisdom you sometimes hear, like, equities are the only game in town, bonds are too risky now. In the Sukuk world, that stability often comes from the link to the underlying asset and this investor tendency to hold.
Okay, but every coin has 2 sides. Let's talk about the flip side, the challenges. The Dubai world and Nakheel situations specifically. That sent some serious shockwaves, didn't it? I remember it hitting the news and thinking, wait, isn't this supposed to be safer?
It absolutely did. And it raises really important questions about, the complexities and potential pitfalls, even with innovative instruments like Sukuk. The key date was November 25, 2009. That's when Dubai World, the government's big investment fund, stunned the markets by asking to restructure $26 billion in debts. The immediate focus, the big worry, was a $4 billion Sukuk issued by its property development arm, Nakheel. Company famous for building the Palm Islands in Dubai.
Right, very high profile. So what went wrong?
Well, the fundamental problem lay in the structure of that specific Nakheel Sukuk. It was based on an ijara, a lease structure. Now, in theory, as we discussed, the SPV in an ijara holds legal ownership. But in this particular case, digging into the details revealed the SPV only held a 50-year leasehold interest in the underlying land assets. And under the UAE law applicable in Dubai, a leasehold right is not considered a real right or a full property right.
So it wasn't outright ownership.
Exactly. It wasn't the secure ownership that investors likely assumed they had. It was more like a very long-term rental agreement on the land. So legally, their claim wasn't as strong as they thought.
And that must have been compounded by assumptions investors were making.
Absolutely. There was this widespread but ultimately mistaken belief among many investors that there was an implicit guarantee from the government of Dubai simply because Dubai World was state-owned.
Even though the paperwork, the prospectus, didn't actually say that.
Correct. The prospectus apparently stated quite clearly there was no explicit government guarantee. But the market perception was different. And this misunderstanding really skewed their assessment of the risk versus the return they were expecting.
So they thought they had a safety net that wasn't really there.
Precisely. And to make matters even worse, the parent company, Dubai World, which was the guarantor named in the Sukuk, was itself in deep financial trouble. It wasn't in any better position to pay than Nakheel itself. And here's another layer of complexity. Dubai World is a holding company. It owns lots of different subsidiaries, each with its own debts and creditors. Because of the way the guarantee was structured, the Nakheel Sukuk holders actually found themselves subordinated to the creditors of Dubai World's other subsidiary businesses.
Wow, so they were further down the queue for getting paid back than even they realized. Below the debts of all these other businesses under the Dubai World umbrella, that's a nasty surprise.
It was a very complex and unfavorable position. The Dubai Finance Department then issued a public statement around November 30th, 2009, basically just clarifying the correct legal position. Dubai World's debts were not guaranteed by the government. Full stop. They hadn't been required to give one, and they hadn't given one contractually.
So the government stepped back legally, but Nakheel didn't actually default in the end, did it?
No, they didn't. Ultimately, a default was averted thanks to a very widely reported $10 billion bailout package, crucially including $4.1 billion provided directly to Nakheel from the government of Abu Dhabi.
Abu Dhabi stepped in.
Yes, that intervention definitely calmed the immediate crisis. But it wasn't the whole story. As part of Nakheel's overall debt restructuring, they also ended up issuing new Sukuk bonds to some of their existing creditors, essentially swapping old debt for new paper. And interestingly, the prospectus for these new Sukuk revealed just how hard Nakheel had been hit. They'd had to write down the value of their property and project portfolio by a staggering $20.14 billion in 2009. It really was a cautionary tale about looking very closely at the specifics.
Okay, so pulling all this together, what does it all mean for you, the listener? We've got the Emirates success story on one hand showing the potential, and then the Nakheel near miss on the other, highlighting the risks. What's the synthesis here?
Well, I think it's clear that Islamic finance, and Sukuk specifically, has genuinely filled an important gap in the financial markets, particularly after the 2008 crisis when traditional debt became scarce. It offered a viable alternative. And the underlying Sharia principles focusing on fairness, transparency, asset backing are fundamentally important. When these principles are applied properly, they really should make Sukuk a safe and sensible option, both for the company raising funds and for the investor holding the Sukuks. The principles themselves aim for a more stable, ethical transaction.
And we saw that with Emirates, right? They showed a clear way to successfully use Sukuk within a broader financing strategy, demonstrating it can be strong and viable when structured correctly and when those principles are followed.
Exactly. But the Nakheel story paints that very different picture. It starkly highlights the risks, particularly with overly complicated structures. And most critically, it underscores the absolute need for crystal clear legal frameworks, especially concerning the actual ownership rights related to the underlying asset. Was it true ownership or just a leasehold? That detail mattered immensely.
The Abu Dhabi bailout was crucial in that case.
It was absolutely critical. And that fact itself really underscores how important robust legal certainty and complete transparency are for these instruments. If that bailout hadn't happened, the outcome for those Nakheel Sukuk holders could have been extremely different. It's a reminder that finance, no matter how innovative, ultimately relies on a solid legal foundation.
It really drives home the point that whether you're looking at this as an investor, running a business, or just trying to understand the financial world better, you absolutely have to understand the precise structure and the legal backing of any financial instrument, especially something as specific and nuanced as Sukuk. Reading the fine print, understanding the legal reality, isn't just advisable, it's essential. You need to know exactly what you're buying into. So let's leave you with a final thought to chew on. In today's world, financial markets are incredibly interconnected, increasingly diverse. How might understanding different financial philosophies like the ones behind Islamic finance not only maybe open up new investment avenues for you, but also challenge some of your basic assumptions about what makes a financial instrument truly secure or inherently risky? What other questions does this deep dive raise for you about that fascinating intersection of finance, law, and maybe even culture? Something to think about.